All right, let's be real. When people hear the words life insurance, their eyes glaze over faster than a Sunday sermon after brunch. And I'm no different. However, you're probably picturing one of those TV ads right now where you hear just $19.99 a month is going to protect your family, right? And guess what? We move on with our day and don't think anything of it. But what if I told you that the Rockefellers, the wealthy elite, and savvy investors are using life insurance as a tax-free bank, a real estate funding machine, and a tool to really build legacy wealth that can last for generations? So in today's episode, David and I have a great chat with Kyle Santos. He is a life insurance expert who is here to destroy everything you think that you know about traditional life insurance. We dive into whole life insurance, universal life, and indexed universal life. What are the differences and how you can use those within your strategy to invest into real estate and other assets as well too. We really dive into infinite banking, which can provide tax-free growth, and how you can stop becoming the customer and start becoming the bank, right? So if you think life insurance is boring, buckle up. We're going to change the way you look at it. So thank you so much for joining us, and let's get right to it. Welcome to another episode of Burn Your Boat's Wealth. I'm here as always with my co-host David Shaw, and today we have a buddy of mine based out of Tampa, Florida. And as David and I have kind of evolved with this podcast, we've kind of learned that the world doesn't always necessarily revolve solely around real estate, right? And real estate has been tough right now. And so I think people are always looking for different avenues, different ideas, different opportunities, right? So today we have Kyle Santos on the show, and Kyle is a expert in everything life insurance, infinite banking. And I felt that it would be a huge amount of value today. I've personally had a whole life policy for over 15 years now. So I know just enough to be dangerous. And so I approached Kyle and I said, look, man, you got to come on the show. You're going to bring so much value to our listeners as a kind of an alternative approach to being able to invest their dollars to be able to leverage it. So today I have Kyle. Welcome to the show. How are you doing today, Kyle?
Thanks, Clark. I appreciate that. I'm doing great. I really appreciate how you approached me to talk about this topic because honestly, insurance might sound boring in general, but I think this is some really cool stuff, and I've seen some really cool things happen with this.
Yeah, I think that it's something that is kind of like when the minute you hear life insurance, right? I hear I'm like, oh gosh, life insurance, like another life insurance salesman, right? Like it's not exactly the greatest stigma in the world. And I think though that people don't have a good understanding of what the hell it actually even is. They just think it's the commercials with the $40 a month, $1 million policy,
Right.
so when you go to the other side, you're going to take care of your family, right? But it actually is much, much more than that. So that's what we're here to talk about today.
Absolutely. Sounds good.
Yeah.
Well, I'm gonna jump in here, Kyle. This topic has come up about 20 or 30 times, or people have asked me. It's like, David, do you have a whole life insurance and do you use infinite banking in your day-to-day life? And I've each time it's come up, I've said no, I don't. And I was like, can you send something over to me? And they do, and I don't read it. And so I'm coming at this, this topic just keeps coming back up. It's just, it's the Rocky 55 of the have you done have you done this strategy? It just won't die. It just keeps coming back up. So there's something to this. There's something I want to learn here today. And so for the listeners, if you don't know about whole life insurance and infinite banking, don't go away because you think that this is an insurance conversation.
Yeah.
This is a wealth building conversation. And so with that being said, I'm going to be the listener and I'm going to be the learner in the room here, Kyle. Clark, you already have one of these and you've just said you've had one for 15 years. So like I am going to be digging into this topic and I'm looking forward to what you have to say, Kyle, and what this product is. But before we get started, Kyle, we can't just drag somebody into the podcast and say, start talking to us about a nuanced subject.
Right, right.
Kyle, Kyle, tell us a little bit about you. Tell me how you ended up in whole life insurance and infinite banking, and why you're sitting in that seat talking to us right now.
No, absolutely. So actually, as you know, I was born in the Philippines and I was raised to be, as my parents would, stereotypical Asian. They want you to be an engineer, a doctor, or a lawyer. And I always thought I was going to be a doctor. I got my pre-med degree at UCF and I was at my doctorate, my DPT program in St. Augustine. And I after 2 weeks I dropped out, and not because I was bad at school. I just didn't enjoy it. I was actually really good at school. I never studied. I always had good grades. Must be an Asian thing. I don't know. But but when I dropped out, I was just, trying to figure life out. And I remember I was scrolling on Instagram one day and I saw one of my old friends, my old bodybuilding coach when I used to do bodybuilding. He got into the insurance game. And I saw he bought this $1 million home. He has these two Mercedes. And I'm like, well, I need money. I want us to have a family. So I was like, I'm going to be an insurance agent. And that's how it started. I started selling health insurance and I worked for United Healthcare for my first year. And then after that, I was like, hey, you know what? I realized there's so much capabilities of being an uncaptive, a true broker. And then that's when I started my own company. And now I have 28 agents in my agency, Future Financial.
Wow.
Yep. And it's grown a lot, but to be honest, there's only a select few in my agency, including myself, that do advanced market strategies like what we're about to discuss today, because it is quite complicated. It can be complicated, but my goal is to use third grade language to make sure everybody can understand. The reason I niche into this was because whenever I'm laid up at night researching something, I knew I was passionate about it. And I wasn't, I think life insurance is very important. I think it protects families, the general life insurance, but I wasn't searching up how mortgage protection works, how final expense works. I was searching up how infinite banking works. What
Yeah.
is Grant Cardone talking about leveraging infinite banking? What is the Rockefellers talking about with the waterfall method? What is Ray Kroc doing? How did J.C. Penney save themselves during the Great Depression? You know, and it all always came back to using cash value life insurance, and that's where I found my passion, and that's how I ended up here. I hope that's a good introduction of how I came from a doctor dropout to here.
Well, Kyle, I wish that we may need to do another episode on how you've grown. How old are you?
27.
So you're 27 with 28 agents, right? So that's a whole different discussion about burning your boats to go from a health insurance agent working for someone to being able to run your own shop with 28 agents. So I commend you. That's an amazing accomplishment. But today, we really want to provide a lot more information about the infinite banking concept. So before we get started, give the listener the nuts and bolts. Like, what is term? Like, what's the difference between the TV commercial you see where it's $40 a month to get insurance versus more of what we're going to be talking about, which is the wealth building side of things? Help people to understand what the nuts and bolts difference is.
For sure. So there are two types of life insurance policies. There is term life insurance, which is what I would say 99% of people have. That is a super affordable premium. And all it does is for pure protection. Let's say it's like $40 a month. It'll give you $1 million death
Right.
benefit. And it lasts for a specific term, usually 10, 20, or 30 years. Now, permanent life insurance, there's two types. There's whole life and there's universal life. Any type of permanent life insurance builds something known as cash value within the policy. Think of it as a savings account within the policy that's gaining compounding interest. So, just to make things clear, we're talking about permanent life insurance today, not term. And I'm not against term, but it has a different use. You
Yeah.
cannot use term for what we're about to talk about today.
Got it. So talk to us a little bit about you've got this universal policy. And just to give the listeners a little bit of context, so back in 2009, I was sitting in a BNI meeting, right? And I'm sure that a lot of people have been in BNI. It's Business Networking Incorporated or industry. And it's just a bunch of people in a room that represent one specific industry, right? So like you're the life insurance guy. Nobody else in the room can be the life insurance guy, right? I was the window guy. I sold windows. And I remember I met a life insurance guy and he said, hey, he kind of briefly explained to me the process of being able to invest money every month. And then over time, it will start building and you'll actually get more credit for the money you're putting in. So I bought a $500,000 policy, and that doesn't mean I just immediately got 500,000, right? And I started paying every month $586. So every month starting in 2009, I just blindly, they drafted out $586 out of my account. And then after about year 4 or year 5, I started getting more credit. So I'd pay 586, but I would get 592. And then the next month I'd say pay the same 586 and I'd get 598 or whatever it was, right? So kind of talk to the listener about kind of what you see in terms of who is actually buying these policies and what can you do with these, and I'll kind of jump into and let you know as to what I've done.
Right, absolutely. Imagine using your life insurance policy as a private bank. And this is like the people that should be using this
Yep.
type of strategy. First of all, I want to put a disclaimer. This strategy only works if you have enough money to fund the policy. So it's actually not for everyone. And the reason there's a negative connotation online about it is because you see people like Grant Cardone talking about it. They're like, oh, he's just saying that. But no, he's saying that because he can do it because he has enough capital to make it happen. So I want to put that disclaimer here. It's not for everyone. It requires a certain amount of income to be able to do this while not living paycheck to paycheck,
What do
right?
you mean fund the policy? So when it requires someone to fund the policy, they get that. You got to pay it every month. You kind of elaborate on that.
So the biggest misconception when somebody just comes up to me and asks me, Kyle, infinite banking, how does it work?
Right.
Do I buy a $40 a month policy and it has a $1 million death benefit? Does that mean I can access that $1 million? No, absolutely not. That's not how it works. You can borrow from your cash value, not your death benefit. And remember, your cash value is that savings account per se inside your policy that's building compounding interest over time. So you can borrow from that. And that's why the more money you put in the policy, the bigger the cash value is. So, for example, I want this to make sense. So, David, tell me if this makes sense. If you have $100,000 in your cash value and the death benefit of your policy is, let's say, $1 million, you can borrow up to $100,000 of your policy, and the collateral for that loan would be the $1 million death benefit. So, for example, if you took that $100,000 out as a loan and you were to pass away and you never paid back that loan, when the time comes and you die, your beneficiary, whether that's your spouse or kids, will not receive $1 million. They will only receive 900,000 because you collateralize that 100 grand. Does that make sense?
Yeah, that makes perfect sense to me so far. Yeah.
Okay.
And that
Okay.
you're allowed now, just a quick question. So Clark puts in let's say $550 a month and has done so for a decade or so. And that accumulates up to, 100,000, 200,000. Are you saying, so that's the cash value portion of it. It's the bit that he physically actually put in and the interest that was compounding on it over that period of time. Does the cash value compound interest?
Yes.
It
Yes,
does.
it absolutely does.
Okay.
Depending if you have a whole life or a universal life, it compounds slightly differently.
Okay. So this nut is compounding over whatever period of time, right?
Exactly.
And then
Mhm.
the nut, which is the cash value, is what I put in plus whatever interest it compounded during that period of time. Then you said there's a death benefit, so that's a different thing, right? So
Yep,
we'll
there's
park,
two
yeah,
accounts in the policy. There's a death
exactly.
benefit and the cash value.
So
So
we'll
that's where it might get confusing for somebody new to it.
okay, so we'll park that. So one is what I put in, and the other is the
There's
notional,
the death
the
benefit.
death
Yep.
benefit. So
Yep.
of the cash value, then I've put in, $500,000. Now I could just put in $500,000 today. Equally, it's not like I've got to do this over 15 years. I could just come in and say, I've got $1 million over here. I'm just
Yep.
going to throw $1 million in, and I could start this right now with a lump sum. Is that correct?
Yes. So actually, I'm going to get into that. I actually have an outline to make everything make sense to a one step at a time. So if you guys don't mind, I could go down from there and
Yeah.
then, obviously guide me with what you need clarity on. Does that
I
sound?
just had one question
Yeah,
as
of
you
course.
guys just on the last thing that we talked about. So you said you've got, let's say, $100,000 of cash value, money that you've put in and accumulated interest and whatnot. And so the cash value is $100,000. You just said in your example that I could take a loan for $100,000. So I can take a loan of up to 100% of the cash value. Is that correct?
Depending on the age of the policy,
Wow,
yes, it can
incredible.
definitely be 100%, usually within 5 years. But year one, expect between, I would say 80% LTV
Yeah.
of your cash value
That's amazing.
from the
Like
beginning.
that is incredible amount of leverage,
Yep.
to be
It's,
able to access right off your existing money
yep.
that's serving another purpose for you. So with that being said, that's an incredible bit of leverage. It's very attractive so far. You're getting a death benefit basically for free. You're parking your money over here, and then you're still getting access to your money to go do interesting investments with, right?
Exactly. You
Oh,
understand it perfectly.
cool.
Yeah. So take us through, because I think what it is because we have a lot of questions, right? We're like, oh wait, that sounds
Right.
cool. Let me do this, right? So this is super exciting, right? I think that when I got my policy and it had a $500,000 death benefit, at the time, let's see, that was 15 years ago. I'm 41, so I was 26. I could have cared less about the death benefit. I was like, it could have been $5 for all I cared, right? I was 26 years old.
Yep.
Nothing's gonna ever bad's gonna happen to me, so I had nothing to worry about, right? So, but I saw that it was like I said, I would go back, it was year 4, right? So I'd put in $500, but I'd only get like $450 worth of credit or 400 or whatever it was. But at year 4, it was like the break even. I pay 500, I get $500 worth of credit. And then that was the tipping point. Do you see that a lot of people can't last out that first 3 or 4 years where they're like, wait a second, this isn't adding up. I'm giving you 500, but you're only giving me like credit
Yeah.
of $400. Talk to us a little bit about that.
That's a great question because whenever I show an illustration, when I'm doing a full finance consultation for this strategy, the first year, first 2 years, especially if you have whole life, it's going to look negative for a little
Yeah.
bit. But people forget when you put money inside a life insurance policy, let's say what we call max funding it, putting as much money as possible for your policy. Let's say it's 1,000, just to make math easy, $1,000 a month. A portion of that $1,000 is going to the insurance company as the cost of insurance in return to give you that massive death benefit, while the remaining of the premium you're putting into it is getting put into the cash value. Does that make sense? Does that answer the question?
Carl, it does. Carl, what I'd like you to do, so that we're all very clear. Clark and I are going to just kind of step back for a minute, and we're going to kind of let you take it from the top, right? Walk us right through from the very beginning to the middle to the end, and we're going to sit back and we're going to have questions at the end of all of this. But
Sounds
take it
good.
away there, Kyle. Take it away from start to finish, so that we can get the full
Perfect.
picture
Get the
instead of
full
us
picture.
interrupting
Yeah,
you.
because I know we're all over the place right now. And yeah,
Exactly. I don't want to break your line of thought. I don't want us to, to break, where you're at. So take it away from here. Start from the very beginning.
so using the life insurance policy in this strategy is using it as your own private bank, right? No taxes, no credit check, no begging the banks for loans, just access to your own capital on your own terms to fund real estate deals or whatever assets you want to invest in and build long-term wealth. That's the main goal for this. So, as mentioned earlier, just a quick recap. We're not talking about term insurance. That's for protection only, and it builds zero cash value. What you want is permanent life insurance. So there's three types, but I'll tell you the last type is not something you should use. The first type is whole life insurance. David, earlier you talked about how you were like, hey, if I wanted to do one big lump sum, can I do that? Yes, that product would be called a single premium whole life. You can't get the type of whole life that Clark got because it's completely different. Now, that's more of an advanced topic we'll talk about in the future. And it's not something I ever tell my clients. They tell me what they want to do, and I know with my own expertise which product to give them. Okay. I don't even know which policy Clark has. He could have a regular whole life where he funds it forever. There's a 10-year pay whole life and a 20-year pay whole life. So these three things, single premium whole life, 10-year pay whole life, or 20-year pay whole life. Those are the three strategies for whole life to be able to use infinite banking. Now, as of recent on social media, an index universal life has been blowing up. That's another way to use infinite banking. And the last one, the third one is variable universal life, which by the way, I don't recommend at all because your money's directly in the market and it could go south very, very fast. So don't do that one. Just to we could talk about that on a different topic,
Yeah.
but that's the one you don't want to have. Um,
What can you talk
yep.
about the index, the second one?
Right. Okay.
Yep.
So, quick difference between whole life
Yep.
and index universal life. Whole life grows at a fixed rate, 4%, 5%, and it's always going to grow every single year, no matter what's going on in the market. So, your money is guaranteed to
Yep.
grow, right? Index universal life is similar, except it's going to be attached to an index fund. For almost every single carrier, it's going to be the S&P 500. Some of them have JP Morgan Chase, whichever index funds that carrier is attached to. But the thing with index universal life is it has a higher potential for growth, but also it could go below that 4%. And let's say the market drops down to negative 10% this year. You're going to get credited 0%. They have a 0% floor, but that means you gain nothing that year. So that's the two big differences. Uh, and I don't want to get too deep in the differences, but regardless, depending how aggressive you want to be, an index universal life is also a great option if structured properly. The biggest scams in our industry comes from index universal life because us brokers have the ability to choose what the cost of insurance is versus how much is getting put in the cash value. Because
Oh.
we only get paid based on the cost of insurance. So if we create it in a way where as much as possible, all of the money is going into the cash value and very minimal is going into the cost of insurance, we'll make like $200 if we do
Yeah.
it properly. But if we make, let's say, $1,000, the cost of insurance is 900, and only $100 is going into
Right.
cash value, we'll make thousands and thousands of dollars. You see what I mean? So that's where it is. With whole life, you cannot go wrong with it because it's fixed. We
Yeah.
cannot control the cost of insurance.
So when someone is when I'm sitting down with you or anyone and you are the one that's kind of pulling the strings as to the split between life insurance versus the cash value, what should I be asking? Like what's the right split?
Is this a max funded policy?
Okay.
That's the one question. And the second question is it an increasing death benefit? And I'm not going to get into the increasing versus level death benefit because that is an extremely complicated topic. Even agents are confused with how it works right now. But those are the two questions you want. You want it to be increasing and you want it to be max funded. That's the
Okay.
only two for an index universal life.
That
If either of those is not a yes, that means some of your money is going into cost of insurance, a good portion of it, and they're just making a massive commission out of you.
Okay, that makes sense. So when you have these discussions with these people, what are some questions that you like to ask to kind of figure out to whether you want to point them left or you want to point them right?
Yeah, so usually if you want to, for example, our fellow friends we talked about before this call, like they're both my clients for infinite banking, and they were telling me they just want to fund something on a monthly basis, nice and
Right.
slow, and maybe 5, 10 years down the road, they're going to take that money and invest it into a property. If that's the case, I would always go with a max funded index universal life because you are more aggressive with the growth and you're just funding it little by little on a monthly basis. But
Cool.
let's say I have a very solid accredited investor who just wants, for example, I'm working with another friend of mine who I will introduce you at the mastermind. He raises capital for real estate syndication, and he
Okay.
has a lot of clients that we have this strategy, which we're trying to find a proprietary name for this strategy, where before they put their investment with him, we're going to put it inside a single premium whole life first, then take a loan out of the single premium
Right.
and give them the money. Now they have 2, 3 ROIs happening before they get that return with a syndication. So if they're telling me, hey, I have $1 million right now, I want to use at least 800 grand from it within next month or within 2 weeks, all day, single premium whole life for sure.
Okay. As you know, well, I'm standing by listening as a very much as a student of the topic, right? So, can I ask a number of questions? So, I have and we're just going to, bring an avatar here. I've got $300,000 lump sum. All right. Um, I can put it in the bank and get 1.5%
Yeah.
return, and I can beg, borrow, and steal from the bank for them to give me a loan for something else that I'm doing, but they'll There's no connection. There's no relationship between generally, the fact that I've got money in that bank and any kind of rate that they'll give me or any kind of credit they'll give me or anything like that, right? So, and they'll give me a pretty low rate of return. But then I can go to a private banking scenario where I could go to JP Morgan Chase or any of the big private banks and I could say, okay, well, here's my $300,000. And they will put my $300,000 into a standard 60-40, equities bond split to increase the value of my $300,000.
Right.
And they'll give me access to, 65% of my money, right? Leveraged at whatever it is, 5.5, whatever LIBOR or whatever it is they're using on the day. Plus, whatever prime plus whatever their spread is. So they'll give me access to 65% of my own money, at a particular rate. But my money is floating out there in equities and bonds space,
Yep.
right? But I do have access to my money, and they're not giving me any real um, credit there in the sense that they'll only give me 65% of it, and they'll margin call my ass as soon as my stocks and bonds go down. They will margin call me. They will sell my stocks and bonds the moment there's a glitch in the
Yep.
market. And so that's essentially private banking. I don't get a life insurance benefit off anything I've said so far.
None.
All right. Then I can take my money, my same $300,000, and I could just invest it in a syndication. Just somebody I saw online is doing a multifamily syndication. I could take it there, and I give my 100,000, 200,000 of my money, and all works out. I get my my preferred return at 8%. And I'll get my, whatever the profit or equity split is further down the line. It all works out going well. But I don't get any kind of life insurance benefit from that, and I'm taking a tremendous amount of risk.
Yep.
From the three options I've just outlined to you right there, why should I put my $300,000 in a whole life insurance policy?
Absolutely. So I want to go back to the money market account you're talking about with private banking. I want to say that it's not necessarily better or worse. It's just different that complements your portfolio even more. Right. But the reason I would prefer the whole life or an index universal life over that is for the sole fact of the tax advantages, which actually I will get to in the next point. There's 3 IRS tax codes that makes life insurance extremely, extremely attractive to wealthy and affluent people. And that's going to be my main answer on that, because your money's not going to be direct to the market. It's inside an insurance company, which is considered a tier 1 asset by all banks.
Well, let's expand on it. I'm all ears. So we've just outlined 3 similar but less efficient ways of putting my notional $300,000 to work. So talk to me, Kyle, about what the advantages of whole life are. And I'm all ears because most people, to your point, who are listening at this point are affluent and they want to hear about tax advantages. So Kyle, talk to us.
Of course. So the 3 IRS tax codes, it's going to allow the money that's in your cash value to compound completely tax-free. So the reason life insurance is tax-free is, if you think of it in a sense, if there's a widow who just lost her husband and they get $1 million death benefit, the IRS is not going to be like, oh, you made more than 600 grand this year. You have a 55%, you're into 55% tax,
right?
Plus half of that, right? So then that's when the IRS tax codes came about. But the IRS tax code is not just for the death benefit. That's one of them. The second one is that compounding interest. You don't pay any capital gains on it. And number 3, you can access your money via loans completely tax-free as well. So every time you're getting, let's say you gain 10% interest because you have an index universal life and the S&P 500 gained 10% this year, right? It increased by 10%. You don't pay taxes on that 10%. And let's say you have $1 million in there and you get credited $100,000. That is tax-free $100,000. And if you ever access it to deploy into your real estate investments or any type of investment, it could be crypto, business, that money is also going to be tax-free money when you access that money.
You're saying that, okay, so it's kind of acting a little bit like a Roth IRA. So I am only putting money into my whole life insurance post-tax. I've already paid money on,
Right.
I've already paid tax on the money that I put into to my whole life insurance policy. So this money is sitting there. whatever benefit in terms of interest payments or growth, if I choose an equity type scenario,
Right.
that whatever growth happens there is tax free. But
Yep.
you're saying, in addition to that, if I take out leverage, I've got $500,000 in my, benefit. I take $400,000 and I do an investment with that leverage. Whatever that $400,000 comes right back into the account tax free as well.
Yes,
Wow.
absolutely. Yep.
Wow.
There
Wow.
is a catch to it. In the
Right.
70s,
There
there's
always is.
yeah, the TEFRA DEFRA law. So I don't want to make these big promises. There are limitations to that. And I guess I'll touch on that now. So before the 60s, there's people like obviously notorious Walt Disney, J.C. Penney, the Rockefellers, all bought this extremely small whole life insurance policies. I don't know the exact numbers, but I'm just going to make an exaggerated example. Let's say it costs $10 a month for something small. And what they would do is fund it, let's say $10,000 a month. So now $9,990 every month is turning tax free and they're accessing it tax free.
Right.
Essentially, they found a loophole to legally
Yep.
money launder, right?
Yeah.
Launder. And that's when the TEFRA DEFRA law came out, where there is something known as max funding. And we mentioned this earlier. Essentially, they say if you want to be able to put in $10,000 a month into a policy, you need to have a certain amount of death benefit, which forces your cost of insurance to increase. And if you ever pass that limitation, your policy will be considered MEC. MEC, it stands for Minimum Endowment Contract. Not that it's important to the clientele, but just for you guys here for educational purposes. When you pass that MEC limit, the whole thing becomes taxable income. All of your compounding interest, all of the money you take out, and even the death benefit will be taxable income if you pass that limitation.
So that I understand, because this is absolute. This makes me rethink everything in terms of how I the flow of my investments go through. And I'm thinking in my head right now, okay, let's just take 100 grand, right, Kyle? Before I go invest in the syndication as a limited partner, before I go dump it into a joint venture, before I even go buy a piece of real estate, what are the downsides of me taking that $100,000, handing it to you as a whole, or as a whole life, or a universal, or whichever one, and then being able to borrow, let's say 80 cents of that dollar to go. So let's say I gave you 120, knowing I needed 100K to get into that
Yep.
investment, right? I give that 100, you give that 100K back to me. Now the policy has 120K of cash value, and I borrowed against it, right? And then I'm going to go drop that 100K with the syndication. It's going to do its thing. Let's say it returns like a 15% IRR. So the IRR is internal rate of return, which means it takes into consideration your cash flow, your distributions, your money you make when they sell it, right? So then I made 15% on that 100,000. If I take that whole 100K plus the 15,000 and I put it back and I return it back to the whole life policy, now I have made the 15K, and that 120K that I initially gave to you has been compounding throughout.
Yep.
Have I missed? I want to make sure that I understand that I have paid zero tax except for the initial money I brought to you that I had to pay income tax on.
Yep.
Did I miss something there?
No, you explained it perfectly. That's
So
exactly what happens.
me, it would make sense for every single investment I make to run through as a whole life policy. And then once I make it, let's say I wanted to take that 15,000 that I made with the syndication and go buy a boat, right? Or whatever that
Yep.
may be. I can still give the $100,000 back. It was still compounding on the
Yep.
120 I gave to you. And then I pay taxes, normal, capital gains on the 15K.
Yep.
What
So
what
you
is
can
the
just
disadvantage of why would I do that on every single investment I do?
there's actually with that strategy, there's no disadvantage other than the fact that you don't have like if you're doing a single premium whole life, obviously the 20%
Right.
that you don't that's going to be the biggest disadvantage you have. But exactly what you said, if you were to pay back that 100 grand loan you took out and then you wanted to buy a boat, instead of using that $15,000 cash that you profited, you can just take another $15,000 loan from your whole life and buy that boat, right? Um, So there's no disadvantage to it. There's a way that it can be done wrong. With
Okay.
that strategy, you need a single premium whole life. And I'm not trying to be self-righteous here, but a lot of the entry level to get the license we have is actually very, very easy. Most people will try to sell you an IUL. An IUL doesn't work like that. If you put in $120,000 up front in the first year with an IUL is something you have to pay consistently. So
Right.
that means next year, if you don't put any money into it because you were under the impression I put in one big lump sum, that's not how IULs work. Your cost of insurance, it doesn't pay off the whole cost of insurance. With a single premium whole life, you paid off all of your cost of insurance right from the start, and you could leave it alone forever and just leverage it forever. With an IUL, the cost of insurance renews every single year. So you see that's when everything will go wrong. If somebody ever tells you, "Hey, I have a lump sum amount of cash," and they're like, "Okay, we'll open up an IUL for you." Big red flag. That's not the right product for
Yeah.
So Kyle, I've been pitched something like that before. They're like, yeah. You put in 100,000, then you put another 100,000 in next year. I'm like, oh, so I got to put 100,000 in perpetuity.
Exactly.
So just to be clear, you
That's
said
that's an IUL right there, or a 10-year whole life, or a normal whole life. But if it is specifically a single premium whole life, then you never have to pay into it ever again.
let me give you a scenario, Kyle. So anybody who listens to this podcast knows that, I was a very aggressive and um, high volume fix and flip person for a long time, and with these higher interest rates and different exit strategies out there, that I stopped doing it. For the most part, not entirely. I never will. But bottom line is that I kind of moved a lot of my capital resources over to private lending. Okay. And I do private lend inside my self-directed IRA. And I'm just not talking about myself, but I think a lot of, the people I work with as well. We fund loans through our self-directed IRAs. But there's always been this kind of catch where capital outside of outside my retirement funds, if I privately lend inside there, let's just say we're lending and we're getting 10% interest, right? Or 12%, let's say 1% a month or whatever. There's always this catch that it's every dollar that we receive in income, it's taxed at full um earned income levels, right? So it makes private lending, which is lovely, and you can spend it right there and then. It works amazing inside retirement accounts, and it works well outside retirement accounts, but it's just less efficient. What I would be better off doing, if this is what I'm hearing, and I'm just going to use that moniker of $300,000, I would be better off taking my $300,000, put it into a single lump,
Single premium whole
single
life.
premium whole life insurance, put the $300,000 over there. And if I'm right in hearing this, I can lend $260,000 of that, right?
Right.
Right. Let's just say I can't
Yep.
lend 100% of it. I can lend whatever, 80% of it. And I can lend that. And then I get all of my interest payments tax free.
Yep.
And then if I want to, I don't suggest anyone goes out and buys a boat, but if I do want to buy a boat, I can just take a loan. Now, what are these loans? What's the rate of these loans? That's
Yep.
that's the question.
That's a great
What's my
question.
cost of capital when I'm borrowing?
hmm So, that was actually my next topic, accessing the money, the policy
Yeah.
loans. So you don't withdraw the money. I want to make that clear. You borrow against your cash value
Yeah.
using a policy loan. So the big advantage of this is that there's no credit check, there's no loan application, there's no income verification, and it's a flexible
Yeah.
payback if you want to pay it back. And if you're doing infinite banking, you should pay it back. But if it's just a one-time thing, hey, I want to buy a property one time and that's it, let it go, you technically don't have to pay it back. They take it out of your death benefit, right?
Yeah.
So
So
when
it's
it comes to
secured
the
against it's secured against your own money.
exactly.
Yeah.
So when it comes to the rate of the loan, now this one is going to be much more advanced than what you guys would probably hear from other agents. Is they're just going to tell you the basic way. You go to, let's say, Mutual of Omaha, very popular A-rated carrier, and let's say you had a cash value account with them, and you're like, "Hey, Mutual of Omaha, I have 300 grand of cash value. I want to take a loan for $100,000," and they'll be like, "Okay." I think Mutual of Omaha right now is 4.5% interest rate when you take a loan out, and they'll give that to you with a 4.5% interest rate. And by the way, that interest that's accumulating, you don't have to pay back because they'll take that out of your death benefit too if you were to pass away. But here is actually a big gem that I've never just said publicly. This has always been in one-on-one consultations. I mentioned earlier that banks see life insurance, cash value life insurance as tier one assets. Same thing as gold, same thing as cash. So it's a very, very stable source of money, right? And when you go up to a bank, you show them your cash value statement, like a piece of paper, and you're like, hey, I want to do something known as leverage banking. They see that as a tier one asset, and you can see loans. Let's say you go up to Bank of America and you show them your 300 grand and be like, hey, I want to borrow 100 grand and I want to collateralize this policy. There, you can get your loans up to 2% interest. It's something ridiculous because they consider it a tier one asset. So that's called leverage banking. And that's how, does that answer with your interest rate? You could go directly from the carrier, or you could involve a bank with it by showing them your statement and collateralizing the whole policy.
Let me give you an example, Kyle. So let's just say this is a like a fictitious scenario, but I own a property free and clear. It's for $500,000, right? Let's just say, right? And if I go to any banking institution right now, and I try and access the value of that, they're going to run me through a ringer. They're going to drag me through the mud. They're going to hang, draw, and quarter me if they can. Right?
Like pulling the equity is.
Yeah. They're gonna want to. You're gonna want a lot of stuff. And then I recently looked at doing some kind of HELOC type scenario as well, on a unleveraged type scenario, and they like just the cost, the points, the application fees, and then the interest rate was 9.25%.
Wow.
Right. And this is on unleveraged assets, right? And that's what a lot of people out there that are listening right now are dealing with. They have equity in they have equity in deals, they have equity in this. Your scenario is very the same, but just instead of having the cash value of something. Now, I'm assuming this cash value, let's say you talked about an equity, like a bond and equity strategy. You gave a word for that. What was it? An equities based account, but you could just have a savings based account that's throwing off like 4.5% or something like that.
Yep.
So what the cash value of the account is offsetting the interest so it's that's what I've just heard here is they're wiping each other out.
Exactly.
The cash value return on the interest on the cash value is offsetting the cost of the loan that I'm taking. So it's basically I'm getting to use my assets, grow them by 4%, and then take that 4%, which has been covered by the return on the account if I just use a bond account, whatever way you guys structure it. And then I can do really cool stuff. Works really well for private lending because you don't always have a loan. So you bang it out, bang it in, bang it out, bang it in, when you have a loan and you don't have a loan. If you could borrow at 2.5%, if that's the real number?
2.5%, 3% against the banks. Yes.
My head is spinning here. My head is spinning because every dollar I've ever invested, I have just used raw capital, and then it comes back into my bank account. It sits there waiting for the next opportunity or whatever, right? So you're telling me I could just put it over here, get a life insurance benefit, kind of for free, and then
it's pretty much free.
and then I can take the capital when I'm not using it and just leave it there. And when I am using it, my interest payments are being offset by the cost of the debt.
Exactly.
I feel schooled here.
So David has the $500,000 house free and clear. So how can he? I guess I missed something here. Is that how can he take that free and clear property, and how does that integrate into a whole life policy to where you can tap into that equity differently than a HELOC?
I think he was comparing liquidating assets.
Yeah, so I would have to liquidate it.
So what I guess a good analogy is if you think of a cash value life insurance policy as a property, the cash value is the equity. But
Okay,
the
yeah.
biggest difference is the liquidation process
Yeah.
takes days instead of months. And also the process doesn't require a credit check, no loan application, no income verification, and it's a flat. You don't have you set your own payback structure as
Yeah.
well because it's your own money.
Yeah.
And
It is.
insurance, yeah.
So let me
I
ask you a question because we're getting as far into time wise as we're
Right.
comfortable taking of people's day. So let me ask you a question then. So there's no argument to leaving your money in a bank account. That just seems stupid now after
Of
this
course.
conversation,
Yep.
right? Because I'm not getting any benefit other than they're keeping my money
And it's
safe.
below inflation. So
Yeah. Yeah.
Right. So that just seems silly, right? I'm getting a death benefit. So tell me how, and you just talked about liquidation. I don't really see why you would want to liquidate it. In the sense that if it's a great place to put emergency money, because if you need it, it's there. If you don't need it, it's doing its thing and it's giving you a benefit, right?
absolutely.
So it just don't put your money in the bank. That's what
Right.
I've just heard. What is the what? And then I get that life benefit, but let's just say I want to end this relationship, right? I just want to take my cash benefit. I want to take my cash in its entirety out of the account,
Mhm.
right? Not in a loan. I want to take my ball and go home. Does my life benefit end at that point in time?
With the single premium whole life, no. If you have a index universal life or a normal whole life, it eventually will. Because if you take the money out of your cash value, what's going like withdrawing it, first of all, you're
Yeah,
going to pay taxes if you withdraw it because now that's going to be taxable income when you receive it back. So that's a big, caveat to that too,
got it.
which I would suggest if you were done, if you just wanted to separate that relationship away from that policy, just take a loan out and forget about it because you never have to pay it back
So
anyways.
yeah, so you're just always using it as a loan,
Always as a loan. I have
never.
the
So when you
past
do
four
draw it
years,
down,
I've tried to think about it. There's literally zero reason to withdraw it. Keep the death benefit, right?
okay. So
But if
on,
you were to take it out
yeah.
and eventually, because if it's not a single premium, if it's a normal type of permanent life insurance policy, a lot of people don't realize they stop paying into it, but that's because the cash value has enough money in it that it's paying on its own. So if you take all of the money out of the cash value, eventually the cash value will run out of money and then you will lose the death benefit.
Got it.
Got it. That makes
Yeah.
total sense. But so when I do draw the cash down, I would pay taxes. So it's a tax-free environment until I draw it down.
Exactly.
On my death, however, does that cash value become like a 1031 exchange? The tax liability expires upon my death. Is that right? That all of the cash value is just transferred over to my spouse,
Nope.
my kids.
Here's the biggest misconception because I've had this, I guess we like to say objection in the consultation. It's like, oh, what happens to the cash value? Does it just disappear? You could think of it that way, or you could think of the 300 grand you put in instead of them receiving the $300,000 of cash value you've put into the policy. Instead, they're getting $1.5 million in death benefit. So I'm like, how can you argue that? Like, do you see where I'm coming from?
Yeah.
It's
So
like,
I've got
okay,
it.
do you want the 1.5 million or the 300K?
So that's very interesting. I'm growing the cash value,
Yep.
and that's growing the debt benefit. Is that correct? Yes.
Yes. Yes.
Okay. So as the cash value grows, the debt benefit grows.
Yes.
Um, I can take it out at any point in time, but I'll be taxed on the gain. Okay, and I'll lose the tax benefit. Okay, we've cleared that up.
Yep.
And then the final question then is: upon my death, I've got $500,000 of cash value and $1.5 million worth of death benefit.
Mhm.
$500,000 of cash value goes away, but my spouse, my heirs, or whatever, do get this 1.5 million of
Yep.
death benefit.
Exactly. Yep.
Okay,
So
so the cash
what?
value it's not in addition to the debt benefit. The cash value then is expires with me.
Yeah, in general, the answer I'm going to say is yes, but not all the time. With an index universal life increasing death benefit, like we talked about earlier, the two questions you want to ask to make sure you're not getting scammed, then it does get added. So I want to give you a scenario to understand it better. Let's say you have $500,000 of cash value and your death benefit is 1.5 million. But let's say you took out $300,000 as a policy loan to invest into something,
Right.
and you pass away before you ever paid back that $300,000 loan. Instead of your family getting 1.5 million, they will only get 1.2 million
Got it.
because that was we collateralized the death benefit.
Yeah.
That's why the reason there's no application process, there's no credit check, no loan application, no income verification is because the insurance companies know they will always get their money.
Yeah.
Regardless.
I,
Got
I
it.
think I think too, and something that we haven't really talked about, but it's just something more personal, is that as I've been paying on this policy 500 and whatever $83 a month, is that, and I know that it's you said forced savings earlier, is like I've looked at that as literally just like a car payment, right? Like it comes out of my account every month. I know in my head it's coming out. And people say, yeah, but you could have used that money, the whole amount, to go invest in something. Like we're just like always sitting around looking at spreadsheets waiting to invest at the perfect time with every
Course.
dollar that they have, right? And for me it's just it comes out, I don't even think about it, right? I've been doing that for 16 years, and it's almost like an accountability measure, right? Because there's plenty of times where, the whole idea of like profit first, where you pay yourself first before you start paying your bills, it's easy to say that, right? Until that payment comes up, that credit card, that
Yep.
medical thing, and then you stop paying yourself first immediately because you've got bigger things to do. So I've looked at this on separate of what we've talked about, but more on just like a personal level, is that it does enable me to pay myself first because it just zaps it out of my account. I don't think about it. I know it's coming, and I don't tell it to pay more or pay less. It's just the same amount every single month. And it's enabled me to essentially, I had like 120 or 130K that had been building up at $500 a month. And I was able to borrow against it. To your point, I was able to email my life insurance guy and say, hey, I need $48,000 to put down on a house. And like 4 days later, it was in my account, right? He didn't
Yep.
ask me how much money I make. He didn't ask me what my credit was. He was like, how much do you want? 48,000. Okay. And then it popped up on my policy. I had a $48,000 loan.
Super
And
quick. Yep.
here's the big thing, is that when I borrowed that money, it was in 2023, I believe. Interest rates are like 6% or whatever it was, 6.5%, or maybe they were even higher. I can't remember. And I borrowed it at 4.5%. So I was
Wow.
like, where are you going to get 4.5%? No, to your point, no qualifications. They didn't ask me how long I've been at my job. They didn't make me send over a bunch of W-2s and tax returns and things like that. It was the easiest money to access, to be able to do that. And then and then it renewed a year later, and it went to 5.5%. So it went from 4.5 to 5.5. And I'm like, I'm still a point and a half, 2 points better than I would be paying if I went and borrowed that. And David's point, he said 9%. So it's a no-brainer. So for me, it's served multiple purposes. Some on just personal accountability on my own finances, which is a big deal. It's hard to quantify that I've just put $600 away. Like if you can imagine someone just putting $600 away every single month, just like clockwork, there's value to that. And then being able to obviously, you play chess with it, was basically what we've talked about this whole time. So there's so many things. Kyle, we've unpacked a lot. I think that it's obviously something where everyone has unique situations. Some people are investing in real estate or crypto, or they're wanting to buy a farm or a boat or whatever it may be. Obviously, having a more specific targeted conversation with you about their own specific experience is going to be able to really provide things. Obviously, we have to keep it somewhat generalized.
Of course. Yeah.
Although we've probably kept it to where we've asked a lot of selfish questions about our own finances and just leverage this podcast. But if people want to have this conversation with you or your team, and they're like, this is ridiculous that I'm not funneling everything through life insurance to get all these additional benefits that almost basically come for free. How do they get a hold of you? How long is a consultation going to last? What do they need to have with them in terms of like preparation to make best use of their time and your time?
Right. So to get in touch with me, you guys could either go to my website, my agency website, it's futurefinancial.us, or I'll drop my direct work line here. It's 954-296-4803. And just tell me like, hey, we heard from Clark, we heard from David. Shoot me a text message and just say that, and I'll know exactly what we're talking about. But Yeah, man, every single consultation is different. For
Yeah.
example, not a lot of people have $300,000 they can just put in a lump sum, like truthfully, right? Some people are like, hey, I want to start being more efficient. Like you said, with personal finances, I want to pay myself first, make sure I'm building that foundation for my
Yeah.
finances. And I just want to put $500 a month and
Yeah.
that it's automatic. So I don't even see it. It's automatic. And next thing you know, 5, 10 years down the road, they have a huge amount of money in their cash value that they can liquidate at any moment. And by the way, with liquidation, I don't mean withdrawals. I'm just talking about loan. Liquidating is
Yeah.
having access to the money,
Yeah.
right? They can just take that loan out 5, 10 years down the road. I don't know, pay their child's college tuition, give their children their first down payment for their first home, or just like you guys as real estate investors, you find a syndication, you find a property you want to flip, then do that, right? I want to give a quick rundown of how simple the infinite banking strategy is. You borrow against your own policy. You buy, let's say you put a down payment on a rental. Once the project is completed or stabilized, you refinance the property and repay the policy loan with the equity. Now your cash value is back and ready to go again for the next investment. And
Yep.
it never stopped growing in the process. So just depending on where the people are at when it comes to their finances, that's when I'm able to guide, hey, you do a 10-year whole life, single premium for those big lump sums, or should you do an index universal life for the long-term goal? So it just depends. So I appreciate you like kind of making it clear that everyone is different. And I
Yep.
know we focus a lot on single premium whole life here, but that's because you and David have the capital to be able to do that. And
No, it's because
Yeah.
we're older. You
Yeah.
know, I think it's because we're older. I think what you're alluding to, Kyle, is that if you're in your 20s, um, you know, you can really build a lot of wealth slowly, and assuredly, at 20s or 30s, right? So that's gonna, you're not gonna just drop $300,000, $400,000. But if you're in your 50s or 60s and you come into a lump sum, you might come into an inheritance. You might come into a scenario like that where you do start getting these things happening in your life, these life events as they call them. You might want to look at it then differently, right? So, what I'm hearing here is that you, the listener, please, please, please give this to your children. Have them listen to this episode right now.
Yep.
And if you're listening to it from your own perspective, call Kyle, and make your investments smarter. It's basically you're getting two investments for the price of one. In fact, three, because you're getting the policy, you're getting the steady return, and you're getting whatever you do with your capital. You're getting a 3 for 1. It just makes no sense to not
yeah,
do it.
I, I
absolutely.
I think that, and I'll leave you on this, and then Kyle, if you'll take us out, is that a lot of, you see nowadays that everyone is analyzing everything. We have all these different calculators and how my cash on cash return, and it ends up being analysis paralysis, right? And
Right.
I think, and this is something where I think David and I differ, because David is able to look ahead 5, 10 years, whereas I'm like, I just need to look to tomorrow. To like, what's the thing I have to do to get to tomorrow to better myself, right? And I'm not able to look out into the horizon quite as well as David is. But one of the things that I noticed is that I looked at buying a whole life policy in 2009, like I looked at buying my first real estate property in 2006. I knew that buying real estate was probably smarter than renting. Okay. Did I know that it needed to have 3 bedrooms or be in this part of town, or that the rent was going to be X and Y? Am I more? No, I didn't. But I knew that it was probably smarter to buy a property versus renting, right? Then I met the guy in BNI in 2009, and he's like, "Hey, if you hold on to this thing more than four years, you're going to make more money per month, and you can borrow against it, and it's got some death benefit thing. It's this, it's that." And I'm like, okay, I have no idea what I'm going to do with this policy. However, I know that it's going to force me to save some money, and it's probably going to benefit me in the future somehow. I have no idea what it's going to be. And so I just started paying, right? Because I knew that it was a better investment than going off and buying the really nice pair of clothes or buying a round of drinks at the bar with my buddies, right? I knew it was probably a better investment. So I just started doing it, right? I didn't necessarily always have the end in mind as to exactly what I was going to do with it, because I really didn't know. But if you don't start, right? If you don't start doing it, especially your age and like in your 20s and your 30s, you're just starting from, you're kind of at a point where it's more difficult. The momentum hasn't grown yet. So if you start when you're like I started when I was 27, It enabled me at 38 to be able to put two down payments on two different houses. And I was able to access that in a week. But it's because I started. It's because I just started, even if I didn't have everything sorted out. So like my advice, especially hearing what you're saying, is like, just start. Book a call with you. Say, look, this is what I think I want to do. It's probably going to change in 5 years. You're going to be a different person in 5 or 10 years than you are today. But that's okay if you start and you start investing and you start for saving. So I'll leave you with that. Kyle, take us out.
No, thank you, Clark. I'm more like you too. I just think about the next day,
Yeah.
and I just make that decision. And it's either we get quick success or we learn real quick.
Yeah.
But no, I appreciate you guys having me here. My final thoughts are when it comes to this strategy and finance in general, you control the money, you control the repayment, and you decide when and how to invest. While you're alive, you build wealth. When you're gone, your family receives a tax-free legacy. It's not just insurance, it's your personal bank, your leverage tool, and it's your wealth strategy. So I really appreciate you guys having me. And, to be honest, we didn't even get through half of my notes. So maybe a different time for sure. But I really appreciate you guys. I hope it was educational.
Well, that's the incentive to book the call with you, right? Is that there's a whole bunch of other cool things going on.
If it makes you feel any better, Kyle, we didn't get through half our questions either. So
Oh, okay. There you go. We'll have to do part 2 then.
Kyle, listen, man, you are a mover and a shaker. I like associating with myself with people that are out there really shaking the trees and making a name for themselves and try to you're always trying to provide value to people, whether it benefits you or not, right? And so I think that mentality is going to take you far. I appreciate you coming on the show. Now it's changed the way that I've looked in terms of doing other investments into like the single policy thing. And we'll have to have a discussion offline. And I think a lot of people listening will want to do the same. With that, Kyle, thank you so much for coming on. You're a rock star, my friend, and we'll see you next time.
Thank you, guys. I appreciate it.
Thanks, guys. Well, that is a wrap for today, folks. We hope that this episode shed some light on the complexities of the real estate market and kind of really gave you some actionable insights. Because remember, you navigate the world of property investment, it requires more than just luck. You're going to need strategy, you're going to need knowledge, and of course, you're going to need a little dash of courage. And if you enjoyed today's episode, be sure to hit that subscribe button. Leave us a review on any of the podcast platforms that you listen to and YouTube as well. And don't forget to follow us on Instagram and Facebook at Burn Your Boats Wealth, and leave comments, talk to us about things that you want us to talk about or things you disagree with us on. We appreciate all that type of insight. Your support really fuels our fire to bring you even more valuable content. So we appreciate you. We appreciate the support, and we will see you next time.
You've been listening to the Burn Your Boats Wealth podcast with Clark Lunt and David Shaw. We would love to hear from you. Please reach out at contact@burnyourboatswealth.com with comments, questions, and if you have a topic you would like Clark and David to discuss on an upcoming episode. We would very much appreciate it if you took the time to rate and review Burn Your Boats on your favorite podcast listening app, and make sure to follow and share on social media. Content in Burn Your Boats Wealth podcast is for entertainment purposes only and is not legal or financial advice. Please review our legal disclaimer at burnyourboatswealth.com. Thank you and have a great day.